Cast is now starting. All attendees are in listen-only mode.
Hello, everyone. Glad you could join us today. I hope everybody's staying well, staying safe, staying healthy, and most of all, I guess, staying at home for almost everybody. Hats off to all of our essential personnel. Definitely a tough time for everybody. So really hope hope everyone on here, your friends, family, everybody's staying safe. Real quick, probably should have done it first, but just want to do a quick audio video check. You should be seeing a slide that says Intro to Nadex Knockouts Touch Bracket Contracts, and hopefully hearing me all right. Looks like we're good. Fantastic. Well, today, as I mentioned, we're going to be talking about knockouts. You might know them as touch bracket contracts. We're actually going to be changing up the name a little bit. So they are the same contract. One of the bits of feedback we had, people seem confused by the term touch bracket because they basically touch out, and we'll explain how they work. But like with everything, we like to take feedback, and particularly if more than one person is saying it, it's probably got some merit. So particularly when we hear it, so the common sense name actually came around as it'll be knockouts because that's what those options are, knockouts. We're going to be diving into those today. Before we begin, real quick on the housekeeping front, this will be recorded. I did do this one 2 or 3 weeks ago. I don't know if anybody else, it seems like time is kind of all running together. It was 2 or 3 weeks ago. Unfortunately, the recording on that one did not take, it got corrupt somehow, so I was not able to post afterwards. Going to try to avoid that today, and we'll hopefully get it out to you, if not later this evening, tomorrow morning. Everybody should get a copy of this. So it will be recorded. And I'm going to be taking questions towards the end. Now, I'm going to try to address as many during the presentation. So if you do have a question, go ahead and type it in the question box. I may answer it during the presentation. If I don't get it during that, I'll definitely make sure I can get to all of them at the end of the presentation. So with that, let's get going. All right. You're probably all familiar with this, the risk disclosure. You should understand that trading involves risk, whether that be Nadex or anywhere else you're trading. Anytime you put real money into a market, you can lose that money. It's the nature of what we do, right? Without risk, there's very little reward in life, but trading does involve risk. It's not appropriate for everyone. You should always manage your risk, and it should always be, I really want to stress this, it should always be risk capital whenever you're trading the markets. If you have money that's earmarked for mortgage, rent, groceries, whatever, don't trade with that. It's just the surest way to lose that money. So, just always understand that. Make your trading decisions. They're your responsibility. I love self-directed trading when we can make our own decisions, but we always have to take accountability for that. So with that, everybody good on risk? Okay, cool, because we're going to be talking a lot about risk today anyway. So what we are going to be talking about today, the markets available, what they are, how they work. We're going to really take a deep dive into these contracts. And we're going to walk through a trade example, but then also we're going to hop into the platform because I think there's been actually, since even a couple of weeks ago or 3 weeks ago when I did this presentation, there's been some cool developments on the new platform that really make these very visual. And so we'll take a look at that as well. So, all right, what markets can you trade with knockouts? So the original pairs, we had 4 currencies: Euro USD, Pound Dollar, Dollar Swiss Franc, and Dollar Yen. Stock index futures, the US 500, Small Cap 2000, Tech 100, Wall Street 30. So if you think about it, S&P, Russell, NASDAQ, and Dow. And those are the indices. And we're always looking at expanding these, which we actually just did a few weeks ago. Really had a lot of requests for these two, crude oil and gold. And if you've been paying attention to these two markets at all, I mean, all the markets, they've slowed down a little bit relative to a month ago. Obviously, they're still moving like crazy for historical averages, but really, particularly crude oil and gold were two of the missing components. So we launched those, I want to say about 3 weeks ago. I want to say it was around March 23rd. Yeah, so about 3 weeks ago. Particularly with the volatility of the markets, and that's one of the reasons why I wanted to do this again, not just because the recording didn't work last time, but The feedback after the presentation was really good. Had a lot of really good questions about these contracts, but we've really seen big growth in these, and particularly in these volatile markets. They do make a pretty unique contract where you can get into a trade on these markets that are moving like crazy, yet still define your risk, which is a very important aspect, particularly these days, right? Because news is coming out all the time. Things that, 1 minute it's all positive, the next minute it's all bad. We don't know what's going to happen next. So if you're in a market where you can't define your risk, you may want to consider your risk parameters in those cases. And if you've got your foot on the pedal, you might want to back it off a little bit if you're trading with a lot of leverage. All right, so what are these contracts? It basically is a range. There's a price range. So think of a floor and a ceiling, right? You've got a low point and a high point. Low price is called the floor, high price is called the ceiling, right? Makes a lot of sense. We're going to show you these on the chart, but between the floor and a ceiling, the value of the contract moves in linearity with the underlying market. So if we're looking at, maybe I'm trading currencies and I'm looking at the Euro USD, maybe I'm typically trading the cash market or the spot market. This is going to move really in lockstep, in linearity with the underlying market. That's why these were designed. They're different than binary options. Binary options are what we call a nonlinear product. These very much move with the underlying market. So if you're trading a stock index future, this is going to move very much in lockstep with that type of market. If the floor or ceiling gets touched by the Nadex indicative index, and that's what you see on your charts is the indicative index, or if it surpasses, right? Sometimes in fast markets, you can get a bit of a gap. So if it goes past the floor, touches or goes past the floor or ceiling, the contract is expired at that value. And again, there's a lot of words in these first few slides. We're going to get into some charts and actually take a look at them. I'm a very visual person, technician by trade, so I like pictures better. So if you're already bored with my voice and just seeing words on the screen, hang on, we're going to get there. So each bracket has a maximum duration of 1 week. So we list the contracts at the beginning of the week. We list 4 contracts per market. So for every market, we'll start out with 4 contracts. And while these have a maximum duration of 1 week, sometimes holidays can impact that. For example, last week was a holiday week, and so each knockout touch bracket expired on Thursday rather than on Friday, right? We can't expire anything if the market's closed, but typically, unless they're interrupted by a holiday on a Friday, they're going to expire on Friday afternoon. If the floor or ceiling is touched and expired, a new bracket will be listed. So we're always going to try to maintain 4 brackets. This is done very intentionally and from a structural perspective, which we'll take a look at in a moment. So you'll have 4 unique touch brackets to choose from. Okay, let's get into the pictures portion because I think this helps explain them a bit better, right? So we have what we call our opening level. What's actually amazing is when I did this a few weeks ago, I had to go back because I had done it. I'd done this presentation, I want to say in December of last year, maybe January of this year, and I had all these really high levels. And then, a couple of weeks ago, I went back and I changed it, and then we went well past it. And now today we're kind of back at these levels. Amazing, amazing how what comes around again. But here, if you look on the left-hand side where that arrow is, that's just the first several candles of the underlying indicative price. So as we mentioned, we've got 4 brackets. Each bracket is going to be offset. And so it looks like a stair-step fashion, right? So in the case of bracket number 1, you basically have where the market is, and the floor is 10 points below that. The ceiling is 40 points above. And then it goes in increments of 10 and stair steps down until where you have bracket 4, which has a floor 40 points below the market and a ceiling 10 points. Now, the reason for this structure is that if you look at this line where the price is, and we'll talk about the risk-reward relationship here, but we wanted to create a structure where whether your opinion was long or short on the market, whether you thought it was going up or going down, there was going to be a bracket there to trade. And so that's the reason for this structure, and we'll really dive into this in a little bit, but that's the basic thing. This is what it looks like at the beginning of the week. Right? And because they're brackets, they have a maximum duration of 1 week. That red line is going to be the expiration. So every Friday, they're going to expire. So let's take a look a bit at how they work. Got the basic structure down, right? We know it trades within the floor ceiling. That's the cap. That's the price range. So all of these are a fixed value contract. So for instance, currencies might have a $250 value per contract. Something like oil may have a $500. Something like the US Tech 100 may have $600. So always understand the market and the tick value you're trading. There's two ways these can expire, right? We mentioned they're a week long. That's the maximum duration. They can expire, though, by price or by time, and they're kind of unique, whereas all of our other contracts only expire by time, not by being touched or by price, right? There's a set time, whether that be 5 minutes, 2 hours, day, week. They'll never close early. In this case, if the floor or ceiling, as we mentioned, are touched or surpassed, they'll immediately expire and a new bracket will be listed. So a touch, in case of the ceiling, just want to give some definitions here. If the underlying indicative is equal to or higher than the ceiling, boom, that contract is knocked out. On the other side, if the index is equal to or lower than the floor, boom. And even if there's a gap in the market, right, the ceiling and the floor are the maximum levels. So let's say you were long, the market moved against you and was approaching a floor, and then all of a sudden there was a quick sudden move and the market gapped 10 points. Now that'd be a pretty big gap, but not out of the realm of possibility these days. All of a sudden the market gapped. Well, never fear. You can never take on more risk or lose more money than what you knew you had the potential to up front. So there's no slippage on these contracts. So even if it gaps past a floor or ceiling, the contract's going to expire at whatever that level was. So if more than one bracket, is expired or touched simultaneously, let's say there is a big gap, the number of new brackets required will always try to list 4. Now, in some cases, if all 4 get knocked out simultaneously, we will not automatically relist. We actually put a safeguard in there because in the event there was such a big move. Now, if you think back to, we always have to be thinking about worst case scenario. So when I was designing these, I was looking at and I ran through a bunch of historical data trying to get, the ranges right, but also look at worst case scenarios and what could happen. And one of the things that was from, what was that, about 4 years ago, when the Swiss National Bank pulled the peg from the euro, right? They unpegged the Swiss from the euro, and the markets moved just unbelievable. I think it was a 40% move in about 12 minutes. Destroyed a market. Huge firms went out of business. People lost more money than they ever expected. One of the nice things about these contracts is even in an event like that, you can't ever lose more than you knew you could going into the trade, right? You knew it up front. So that's one really big safeguard that I found, because often I find when accounts blow up, it's in some cases it's a kind of a slow, just doing things wrong, but typically people will step away. What we always want to avoid are what we call those black swans, which really it's almost hard to call them black swans because so many times they're happening so often where we see big moves. But in an extreme case like that, we're not going to relist any contracts until we've had a chance to look and see what's going on in the market, right? Till we basically said, hey, we want to reset these because something crazy is going on here. Until we understand that, we're going to relist those. Now, it's kind of funny when we were going through and I was doing the specs, putting together the specs for these, and we had a call, and I was walking through with the CEO at the time and a bunch of other people, and ran through the scenarios where, historic scenarios where we'd see all of the brackets knock out simultaneously. And it was such a rare occurrence, we still had to plan for it. Although what was amazing was, so we're thinking, well, this could be a one-off scenario that'll happen every once in a while. Literally the first week we launched these contracts, over our close from 5 p.m. Eastern to 6 p.m. Eastern, there was big news on the yen. So the market was closed. Now, even though our market is closed, we still have an obligation. And so this is one that comes up from a question on the last webinar. So if we're closed, right, we have an hour maintenance window basically every day from 5 p.m. to 6 p.m. Eastern. What happens if a bracket is knocked out over that time frame? Well, in that case, when the market reopens, a new contract is listed and the previous contract is settled. So even if it happens over the close, and let's say you were long and it went up and hit the ceiling and then dropped back over the close, don't worry, that contract is still going to be expired, so you would realize your maximum profit, or if it went against you, it would also close out for a loss, but you're always protected on that side. Now, in the case, though, where this happened literally the first week we launched these, over the close, there was big news out of Japan. The dollar-yen pair moved crazy. Because we were closed, though, it wouldn't have happened if we weren't closed. Because we were closed, it knocked out all 4 brackets. So when we reopened at 6 p.m. Eastern, my phone started buzzing. We all got on a call. We said, hey, nope, this was just a one-off. Wouldn't have happened if we weren't closed. And we relisted those 4. So just to let you know, in the case of really big markets, there may be a time if all 4 get knocked out, we just want to take some time and reassess what's going on with the market. Is it good to list these again, or is there something bigger going on that we may want to hold off for a little while? All right. By the way, these are the same as any market. I think a lot of times when, and I've heard it from a lot of people, when they look at Nadex, they think it's a different market. We're just a derivatives exchange. And what that means is we have our contracts based on an underlying market. So it's the same as if you're trading Forex, trading futures. If you think the market's going to go up, you buy. If you think it's going to go down, you sell. The rest is about trade management and risk management. All right, so here's how they work. So this was the previous sequence we saw, right? Let me flip back for a second. So if you look here at the left, this will move pretty fast where the arrow is. Right? The market moved up. So here we have the market. It moved up. It hit the ceiling of bracket number 4. So at that point, bracket number 4 is knocked out. Right? It's gone. A new bracket is going to be created almost simultaneously. Not quite simultaneously, but within second or two, new bracket is created. Right, so this one gets knocked out. If the market continues to move up, you'll see these brackets continue to build in stair-step up fashion. If the market continues, if it starts moving down, it moves down, it'll go down in a stair-step fashion. Right? So this new bracket was created. So whoever was long, bracket number 4, they would realize their maximum profit. Whoever was short would realize their maximum loss in that scenario. So let's say the market moves down. Okay, the market dropped to the floor of bracket number 1. That bracket is now knocked out and a new bracket is created, right? So if it's moving down, it'll go in a downward stair-step fashion. By the way, the same offsets for the new brackets always work, or always created basically the same way. So bracket number 1 gets knocked out. The configuration for bracket number 4 would actually take impact. So the new bracket would have the market plus 10 points and the market for a floor of minus 40 points. Right? So they're always going to be in configuration of the same time. So when they expire by time, right? So we looked at how they get knocked out, right? They're going to expire whatever that level is. If that indicative index touches it or goes beyond it, that's the level they're going to expire at. These, though, are considered variable payout contracts, so it's not an all or nothing like a binary option. These can expire by time, much more like if you've traded our call spreads contracts. This is when they expire by time, how those look. So 1 week duration, we'll have, if provided we have the 4 contracts, they haven't all been knocked out and relisted, but typically there'll be 4 contracts going to expiration on the last trade date of the week. So the expiration value is calculated the same as all of the markets. So if you have a binary option, a call spread, and a touch bracket or knockout contract, all expiring at the same time, they'll all have exactly the same, what we call expiration value. Now, what this means from a P&L standpoint is when a touch bracket or a knockout is done, we're going to use that expiration value calculation to determine profit and loss on your position, right? So they're variable payout contracts. Very easy though. Don't let variable payout or anything like that confuse you. Profit and loss is simply determined by the difference between where you bought or sold a position and the final settlement value, right? Just like any other trade, right? If you bought a contract and it went up and hit your limit order, your profit is the difference between where you bought and where your limit hit. If you bought and it went down, your profit and loss is the difference between profit or where you bought and your stop. Now, in this case, there's not a limit or a stop because this is by time, but it would still be the same differential between those two things. So let's say we're at the end of the week. That red line is Friday. We still have 4 brackets going. Say the market expires with a settlement value of 27.80, right? If somebody up here had sold bracket number 1 at that level, let's say that was at 28.10, right? They would realize a profit from 28.10 down to 27.80 or $300, not including exchange fees. But all of these brackets are going to expire at 27.80, right? That's the final settlement for all of those. So they'll all expire at the same level. And that's how they expire by time. Wherever the underlying market is, the underlying indicative, that's where it's going to expire, and they'll all expire at the same level. So let's take a look at some risk, reward, and capital requirements. You've probably got the understanding of the risk down and the potential reward, right? Because they're capped and the capital requirements involved. The nice thing about these is you do know your maximum risk and potential reward before the trade is placed, right? The floor to ceilings actually provide really good control over risk and natural profit targets. It's really a built-in plan for every trade. I recognize a lot of names here on the webinar, so a lot of you have heard my voice on these things plenty of times, and most of you will know that I'm a big proponent of risk management and having a plan for every trade. The biggest thing I've seen in my 20 plus years in this industry is one of the biggest things, particularly newer traders do, is they don't plan for profit and they don't plan for loss. They go in, they buy, they don't really have that pre-made plan. One of the things I love and one of the best feedback, or one of the most prevalent feedback, I should say, that I've received on these, which also the best, is that people love them, particularly a lot of our educators that we're working with, because it really helps stress to their newer traders, as well as newer Nadex traders, the importance of having that plan. And so this is basically discipline by design, what we refer to it as. So if you don't have a lot of discipline, if you've been trading some other markets and maybe the market goes against you and you start moving your stop away, you can't do that on these trades, right? You can close out early if you want to mitigate some of your risk, or you can take profit early. Nothing wrong with that. But at least you have a maximum risk reward plan on every trade. So on the risk side, right, buyer's maximum risk is just the difference between where you buy and the floor. Just the inverse for a seller. The maximum risk for a seller is the difference between the sell price and the ceiling. Reward, again, just the opposite. Buyer is looking to go to the ceiling. That's their maximum potential reward. Seller side, they're expecting the market to drop. They want it to go to the floor, right? That's the maximum profit potential. And so you know those two key figures going into the trade. So let's take a look here at bracket number 1. Now, one of the things I'll mention here is in the design, since we're talking about risk reward and the way they were created, Right? In this case, bracket number one, if I wanted to buy this contract, bracket number one, based on the current underlying index, is going to have the closest floor. So I'm going to have the lowest risk to highest potential return scenario in bracket number one if I want to be a buyer. Bracket number four, if I want to be a seller, is going to have the market closest to the ceiling. So that's going to be, if I wanted to sell, my lowest risk to highest potential reward. Now, one note on that, right? Just because we have the lowest risk trade doesn't always mean it's the best trade. What I mean by that is, if you look at the market here, let's say that this started and all of a sudden the market though is sitting down here and it's only about 10 ticks away from the floor. We could get into a really low risk trade, but that might not be enough room for the market to breathe. What I mean by breathe is, it could be very easy just to have this knocked out right away. So in some cases, if the markets move down, right, you might want to look to bracket number two. You take on a bit more risk than in the first bracket, but you've given the market a little room. You're not smothering it. So these are things to think about as you're trading it. Just because it's super low risk doesn't mean it's always the best trade. All right, so let's focus though on bracket number one and walk through the risk reward. There it is. So we got bracket number one, right? We've got a start, we've got an end, that red line. We've got a floor, in this case 2710, ceiling of 2760. By the way, so this is a $500 total value contract. So the range is 50 points. For the US 500, it ticks in 0.1. Each 0.1 is $1. So if we buy this contract at 27.20, the floor is maximum risk, in this case $100. The ceiling is our maximum profit potential, right? In this case, that's a maximum profit potential of $400 on one contract. Of course, you can trade multiple contracts if you like, but on one contract, this trade, $100 risk, $400 potential reward, not inclusive of exchange fees of $1 per contract. One thing I want to point out, though, when we're looking at this, and I'm going to reiterate this a couple of times because I really want to drive it home. Let's say you buy this contract, and all of a sudden it goes up to 27.50, right? So it hasn't hit the ceiling, and it's going along, and it's kind of just moving sideways. You don't have to just sit there and wait for it to hit the ceiling. You could try to close out with a limit order, or when you get into the trade, and I see this, I think it's a great strategy for people that are trading multiple contracts, even if it's just two contracts. What they'll do is, once the market moves, they've got $100 risk. Let's say the market moves from 27.20 to 27.40, right? So they made $200 per contract. They'll already have a limit order out there to close off one contract, to take profit on that one contract, right? And then if it continues higher, they'll be looking to reevaluate. And so they kind of do what's called scaling out by doing those limits. On the sell side, right? So because we have multiple brackets, this is bracket number 4, ceiling of 27.30, market's at 27.20, floor of 26.80, again, $500 contract, maximum risk for a seller, wherever you're selling, to the ceiling, maximum profit potential, wherever you're selling, to the floor. So hopefully that's pretty clear. Again, one of the things I do want to stress, you don't have to hit these maximum boundaries. In a lot of cases, you may want to just take a smaller loss than the maximum, or you might want to take a smaller gain than the maximum. The capital requirements are very easy, and it's going to show you on your order ticket before this, but one of the great things I know is maximum risk before it happens, before the trade is placed. This is so important, particularly in what we've seen over the last month, or really any time. If you want to be able to sleep at night, this is something that is huge, and one of the things I'm most proud about, I think, with all of the Nadex contracts and how we're designed, is that in every trade, your maximum risk up front. You can never lose any more than that. If we look back on the last month, and I don't have any stats backing it up, but if you look at people trading the futures markets, and I'm not even talking, I've heard of big firms, big market making firms that pretty much went insolvent last month. So it's not just you and I as individual traders that are taking these risks, but big firms that get out of whack. Um, they're professionals, right? They should understand every aspect of risk. But it is amazing to me over the years I've been around and working on all sides of the industry that, I mean, firms don't always have a great grasp on what their exposure is to overall risk. Um, in the last month, I don't know how many margin calls in the futures side for individuals and even firms where they couldn't meet their capital requirement because the market moved so much and they were highly leveraged, and it just went against them, right? Never going to happen with Nadex. We haven't had a margin call in the history of the exchange, and just the way we're structured, we never will. So that's one thing. And having been on the broker side of the industry back in the 08-09 period, and even before that, when we started seeing markets really kick up, I remember one day in 2007, we literally margined people out. I think it was 15,000 people in Japan, and I don't remember how many. Maybe it was 5,000 in Japan and 15,000 in the U.S. Individual traders in one day. It was actually a big move. It was the first time I'd heard of the impending credit crisis, and there was central bank intervention by the four major central banks, U.S. Fed, Bank of England, and the European Central Bank, who all put liquidity into their markets at the same time. Bank of Japan pulled out a bunch of liquidity. Markets flipped really quick, and people that had, say, $3,000-$5,000 in their account, in many cases, if they had sizable positions on, would end up owing the broker. Not only did they lose everything, but they'd end up owing the broker, another $5,000 or $10,000. Not a good position to be in. But that's the great thing about these contracts is your maximum risk, and you can never lose more money than you put up for a trade, right? You can lose all of that money. Don't get me wrong. Doesn't make it easy. You can lose all of that money, but you just can't lose more than that. So whatever your capital requirement is, whatever your maximum risk is, that's your capital requirement for a trade. And that never changes. So if you've been trading futures market and you understand like what overnight margin is versus day trade margin, right? With a touch bracket, that requirement never changes. So you don't have to worry about two different levels, funding levels. Whatever you get in, whatever your maximum risk on that trade is, it never changes over the course of the life of the contract. Stefan, I'm going to take that question when we get into the platform. So just let everybody know when we go into the platform, I'm going to go in and I'm going to show you how you put on the limit orders, how you enter a position, and then how you put on the limit orders to take profit early. So I'll get to that in a little bit. That's a great question. I think something very important for everybody to understand. Buying or selling are the same at Nadex from a risk and a capital requirement perspective. Whatever your risk is, that's what your capital requirement is, right? The whole way these are designed is to minimize capital requirements, yet still give you a good opportunity if the trade goes in your favor. It's really a benefit of leverage without unknown risk, right? Leverage is a double-edged sword. I've traded a long time with leverage in futures, leverage in Forex. But it's really important to understand how position sizing works. And I also understand when I'm in those markets that I have an unknown risk, right? Because I'm using leverage. If it's running in my favor, it's great. If it's going against me, it can go fast. With these, you get the benefit of leverage without the unknown risk. Oh, and actually, Jeff, I'm going to answer that question in a bit. But then I'm going to also direct you to a video. The question is about the RSI, which is one of my favorite indicators, but I use it a little bit differently. So I'll get to that in just a bit as well. So see our previous example here. Whoops. Very easy, right? If I'm buying 10 points, my capital requirement, this is a $500 contract, my capital requirement is $100. That's my risk. If I bought it 27.15, had 5 points risk, my capital requirement would be $50. If I bought in the middle of the $500 range, my capital requirement is $250. So this is actually a question that I'll take right now. If I buy a contract, who takes the other side? So one thing to point out, Nadex is an exchange, so we just match buyers and sellers. We can never take a position in the market. as a firm or any of the employees. None of us are allowed to trade Nadex live, right? We have to remain unbiased to any trade outcome. Typically, Nadex has what are called liquidity providers. They're market makers. The market makers are there to put quotes in the market. And I want to clarify this. They don't actually place orders, right? So all they can do is quote. They're basically the suppliers putting inventory on the shelves. So that if somebody wants to go, buy a can of soup, they've got a can of soup they can buy. They actually take, both sides. So they're putting their quotes. Also, and one thing I'm going to talk about when we get in, the bid offer spreads are pretty tight on the knockouts already, but particularly when you're looking at like a binary option. CB, on that question, it could be any member of Nadex, right? If you put in an order that you want to buy and it matches a level that somebody wants to take that sell, and I'll actually hit this one a little bit more when we go in, but it is other members of the exchange who are always on the other side of the contract. And it's the great thing is it is purely anonymous. So nobody knows if somebody's opening a position, if they're closing a position, if they're closing a position, if it's for profit, if they're closing it, it's for loss. We have multiple liquidity providers, thousands of members all trading, all trying to match each other. It creates a fair, transparent market. So if you ever have a question about a settlement or a fill, you can always contact our customer service and get a time and sales report, so you can see exactly what was happening. And these have been pulled for a lot of people. If you want to, maybe a ceiling gets hit, and you say, I didn't think it hit the ceiling. I was looking at this other platform over here, and it looked like it didn't hit it. We can provide all of the underlying data to show time and sales and how we do that, and also for expiration. Excuse me. Take a drink of water here real quick. All right. So we're going to walk through a trade example, and then we're going to go into the platform. And I'm going to actually, from the questions we've got so far, I think I'm going to be able to answer those really well because we're kind of getting them stacked up here. This is a great crowd. Really appreciate the questions. These also help as we're formulating education and different things for the for the exchange for our members. Love the questions because they're very important for us to understand so that we can build the right education for everybody involved. All right, so let's put it all together now. All right, we've talked about what they are, how they work, risk reward, and capital requirements. So let's take a look here. This is the Wall Street 30. It's at 24,375. This bracket structure should look pretty familiar. Now, if I want to be a buyer, right, I'm going to probably in this case buy bracket number 1. That's going to give me the best risk to reward scenario. So we've got our contract expiration. Here's bracket number 1. By the way, you're only trading one bracket. You're not trading all 4 brackets simultaneously. So you're not trading all brackets simultaneously. That question does come up occasionally. You're only trading these as a single bracket, and we'll take a look at those examples. All right. So this is bracket number 1, right? We've got a floor, we've got a ceiling, we've got an expiration time, we've got our buy. In this case, we bought at 24,375. The floor is 24,275. This is also a $500 contract. So our maximum risk is $100 in this potential, with potential of $400 return. So we place this trade. Now let's say something like this happens, right? So the market came out, we bought, and it went against us. Just because we know our maximum risk doesn't mean we have to accept it. We can close this out. Again, when we get into the platform, I'll show you how we do that, right? I mean, or we could let it go. Maybe this was fully acceptable to us. We had our plan. Say, okay, if it hits the floor, I'm out. That's all right. The market proved me wrong. It happens, right? And one thing I want to point out on the other side, if the market does this, we could also close out early. In this case, it hit the ceiling. I want to walk through this example. So it hit the ceiling, right? So this bracket is now expired at 24,775. So $400 profit, not inclusive of exchange fees, which if we did one contract would be $2. So not bad, a net of $398. So came up, hit the ceiling. Now, one thing we can look at, because a new bracket will be listed, right? When that one expires, a new bracket will be listed based on the standard configuration. Let's say, by the time we got over there, looked at the new bracket, it had moved up another 5 points. In this case, we could buy this contract again, right? Where our original buy was down here, So now we can't lose more than this. This is almost like a built-in trailing stop in a way. So the market moves up. We decide we want to get in again, right? Again, we've got our $100 risk with a potential of $400 return. In this case, it didn't go up to the ceiling, right? Kind of came up. This is the end of the week. And our expiration is at 24,990. So 24,990. In this case, we have 210 points difference between where we bought, right? So in this case, we'd have a $210 profit, not inclusive of exchange fees, so a net profit of $208 at expiration. If we had, say, come up here and sold this contract at, say, 25,000, we'd lose our 10 bucks on this expiration, right? And so that's kind of walking through a full trade example. We're going to hop into the platform real quick. I'll come back to this screen, but I want to take a look at the platform. And I know a lot of you are using still our traditional platform. I'm going to actually take a look at some of the developments we've done on the new platform, which is still in beta, but from a touch bracket perspective, I think to me, they're pretty cool because they're something I've been looking for a long time. So let me just flip over here and hop into the new bracket. So this is the new platform. Has anybody here tried out this platform yet? We've actually seen a pretty big adoption rate. We're not getting rid of the old platform at any time. We've still got a lot of features to add to this. A lot of stuff is still basically in development. We're going to bring it up to parity. We've got a lot of cool new developments. The one thing about this platform is it allows us to develop really fast, whereas the old one is really built on legacy technology. Oh, glad to hear it, Timothy. We're going to be getting a lot more functionality built in. So this is the new beta platform. So if I wanted to find at the top here, this is what it looks like when you log in. So if I wanted to look at binary options, call spreads, touch brackets, right? So here's the touch bracket contracts. I'm going to go to the US 500. And I'm just going to select any one of these strikes, right? Because I'm just going to bring up a chart. If the chart wasn't already up here, it would bring it off. Now a couple of cool things. I don't know if anybody else here is a technical analyst or likes to use technicals. I personally do. I don't use a ton. I'll be honest with that. Somebody asked earlier about the RSI, which I'll touch on. I do use it, but not in the same way that that it was designed. But I'll show you where you can get a full video on how I use it and how I've used it for years. So one of the things I want to do first, I'm going to bring up this chart for this touch bracket. I'm going to give myself a little bit of room. So if you saw those two arrows, I clicked that. I'm going to close my open positions for now, and I'm just going to bring up the chart, right? So I can start to look at my analysis. If you right click on the chart, you've got indicators, drawings. You can also do it from the upper part up here. If you add these, here's a whole list. I already had some pre-configured. That's why it popped up like that. So whatever indicator you're using, just wanted to show you on the charts there real quick. So let me go back to my markets here. If I wanted to bring that back up and click on my markets. Oh, you know what? We actually just had a bracket knocked out. I don't know if anybody caught that. Oh yeah, TB. Real quick, yeah, you can switch between platforms very easily. So if right now I'm in the new platform, if I wanted to go to the old platform, I just click open the old platform up here in the upper right, and then I can go back to the old platform. We still have a lot of people actually doing that because there's a couple of things on the old platform that that are available that aren't available yet in the new platform, and so they kind of maybe they trade from the new platform, but then they go back and they do more account management from the old platform. So yeah, that's going to be around for quite a while yet. So no worries there. You can try them both out. All right. So I'm going to go here. Oop. And I'm just going to click a buy order. Oop. All right. Oh, you know what? I wanted to bring up a limit order here. Forgot to change my defaults. So if I wanted to buy this one right now, I'd have a pretty bad risk reward ratio, right? So let me just do this. I'm going to go here. The market is at 27.66, right? So maybe I'm going to buy the lower one here. Go to limit order. So if I buy this contract, my maximum potential loss is 94. My maximum potential profit is 406. So I'm just going to place this order. All right, so I get my order confirmation. Pops up there for a second. And I'm going to bring up my open positions, right? So now I have one contract that's in Euro USD. Oh, I've already got a profit of $5. How about that? By the way, if you are in your live account, don't follow along with any of my trades. This is in demo. I'm not doing any analysis. I'm just simply illustrating how the platform works. You know what? I'm actually going to buy another one of these because I want to show you a couple things. So now I have two contracts. So one thing I may want to do, right? If I want to set an order to take profit, right? So right now the market's at 27.64. I've got two contracts on, right? I've got no orders though. I've got no orders. I've got one open position. I'm going to take a limit. So let's say I'm just going to click on this. And I always recommend click on it from your open position, because if you try to open up a new ticket from over here, there's a pretty good likelihood that at some point in your trading life, you're going to hit the wrong one. And then you're going to have a limit order not associated to the trade you actually have on. So if you're going to set limit orders, always set them using the open position window. It will always open a ticket in the other direction for the same size. So real quick, if I just wanted to close this order, you know what? I'm down $22. Let's just say that I wanted to close out the position, right? I open that up. I just click place order. Boom. I got filled. So the market, in this case, had gone against me, but I didn't want to take the maximum loss. I just click on my open positions, and we'll walk through when we're doing the limit again. So, you know, I'm going to go in. I'm going to place a couple of contracts here. Place order. All right, got my confirmation. Here. Thought I had my confirmation there. Okay, so this went to a working order. I had a limit here. If I wanted to, this is actually another important part. On this one, I've got my open position, or I've got my working order. Let's say I wanted to change this or just get rid of it. So if I've got a working order, I can just delete it, or I can amend it. So I'm just going to say, you know, I'm going to buy it up here, click amend order. Oh, and we got filled right away. So I amended the order. So now we've got the open position. So let's say I wanted to set up a limit order to take profit. We've got two contracts. We're long two. You can see that by that +2. Right. I'm going to click this. Before we closed out the market, now I want to set a limit order. So what I'm going to do is, let's say that my analysis says I think we can hit 27.85. 27.85. So I can use the up down arrow here, or I can just go 27. Whoops. Sorry. Fat fingered that one. 2785. For some reason I keep hitting a bad key. 27. Okay, there we go. My other keyboard must be turned off. So now I've got a limited price, but maybe I just want to take one contract off, right? Now I can set a working order for 27.85 right in here. So I've got my order for 27.85. I'm going to click place order. Right. So I've got that. One of the things, by the way, that is in development is when you do have a limit order out there working, it's actually going to show you where your orders are sitting on the screen. So now we've got an open position for 2 contracts and an order for 1. Now again, I'm going to go back to my open positions. Maybe I want to set a second limit order, right? Because our ceiling in this case is 2806. So I already took 1 off, or set 1 to go 27.85. In this case, I'm going to go to my limit order, and maybe I'm going to say 27.95. 27.95. I'm going to place order. Okay, so now I've got, and this is something you always want to double check, I've got an open position I'm long to. In my working orders, I've got 2 orders here at different levels. So as the market goes up, and if it hits here, right, it's going to take out that first limit. If it continues up, it'll take out the second limit and close my position. Now, it might come up actually and close out the first one, which will take away this working order and close out 1 on the position. But if it starts to drop again, right, I may just want to go and close out that position. So this is something else that's really important, right? So I have my open position. And let's say that I decide to manually close this position. Look on this. I'm just going to say, you know what? I want to close it out here. I'm going to sell it. Place order. Okay. So now I've closed out my open position. Here's what I absolutely have to do next. I always want to double check. If I look and I see that I have 2 working orders, if I have 2 working orders, I might not want those in there, right? Because if the market comes up here, it's automatically going to sell, but I don't have a buy order in place. So what I want to do is I'm just going to click on these and click delete. So I deleted that order and click delete this order. And so I have now no open orders and no open positions. So I'm not worried about getting filled. Great question, Tim, on can you have an order to simultaneously prevent loss? That is actually something that we're working on. It's in development. Nadex historically, because we've been so prone to binary options where stops aren't such a thing that you want just because of the volatility of how they move. There's a lot of gaps. So it took us actually a while to figure out how to do those. We are working on the stops. So while you don't have those yet, they're hopefully coming in the next couple of months. It was a bit bigger piece of work than what we expected when we first started speccing them out, but it will be that at this point for the loss, you have to manually close yourself out. One of the importances of the floor, though, on all of our contracts is that they do mitigate that risk. But still, if the market runs in your favor, we want to be able to have the functionality of the stop as well as the limit. And if you can do like an OC order or one cancels other, that's something we're working on as well. I think it's a big missing piece. So let me just see here. We walked through those. I'm going to go through. While we're talking about touch brackets, I'm just going to go here real quick. Let me go to Forex real quick. You know what? Let me, yeah, I'm going to do Forex. So I'm just going to click on this. So now we've got our Euro USD. Oh, now we've got our Euro USD pair. And for some reason, I didn't refresh my screen before, but one of the things I wanted to show you, right? So I'm going to go ahead and get rid of this here and here. Okay, so if you look on the left-hand side of the screen, right, and this is something the old, yes, CB, that's also part of the plan with the trailing, the stop functionality be first and then followed by trailing, which I think will be very important, particularly for contracts like these. Right, so if you click on these brackets, basically, let's see where you're at, right? These brackets are pretty wide, so I'm just going to scale out here. now you can see like this might be the most optimal bracket to trade where the ceiling. So previously in the old platform, right, they weren't very visual. You couldn't really see where you were at in the range. You could kind of make some estimations, or you could draw horizontal lines. But if I just want to flip through these contracts, right, I can do this. Maybe I wanted to be long. Oops, excuse me. Sometimes, there we go. So now if I want to be long, right, this might be the contract that I choose. So I'm just going to go over here because now I can quickly see I'm not that far off the floor. By the way, if I want to buy this one, right, I'm just going to click buy there. It's going to open up my order ticket, right? And I can then place my order, right? But I can easily see there where it was, these were there before, but they actually were like a lighter yellow color. And we got a lot of feedback. So we went ahead and made these blue, which people seem to like a lot better, a little bit more visual. But now you can easily see where you are to the floor or ceiling, right? So if I was looking at this one, I might say, well, gosh, I don't want to take this one because I'm almost, I'm a little higher than center, but I'm almost in the center. Maybe I want to, if I wanted to sell, choose this one, right? Because I'm closer to the ceiling, not right up on it, but I'm right there. So let me hop over here real quick because I want to answer one of the questions, and I'll let's see, because I think I can just going through. Oh, so the question. Let me go back to CB's question on who takes the other side. So I mentioned liquidity providers earlier. You're like, why? The question is, why would anyone want to sell you the contract? Well, liquidity providers, market makers on the exchange have an obligation to quote double-sided markets. And so if you look at this particular, now this is demo. There's actually more market makers in the live platform. So you often see tighter bids and offers in live than what you do in demo, and there's a little bit of difference. By the way, just to clarify, demo is only there to help you learn the platform and how the contracts kind of work. Not recommended for thinking you can learn how to trade in a demo. Psychologically, it's just different. They're there to learn the tools. And so a lot of people can be successful in the demo. They typically don't trade how they do in live. They don't have the psychological implementation, but that's the thing to understand about demo. They're to learn the tools. So to get to where we're at, and you know what, I'm going to hop into the live real quick, actually, before I do that, because I want to talk about other side of the trade and how everybody. I'm just going to go into. This is actually going to be binary options here for a second, because I want to illustrate the order ticket. So don't worry about the contract type. We're here to focus on knockouts today. Let me scroll down here. So I'm just going to do this. Right. So if I want to buy or sell this, so I have my binary strikes. So who's on the other side of this trade? Right now, if I show market depth, right, here's the book. Here's the depth of market. So this is the best bid, best offer, right? And then there's size behind it. Again, this is demo. You'll actually see a lot more activity in the live market. So I could hit this, and this might be a market maker, or this could be another member. But something I want everybody to understand, and this is whether you're trading touch brackets, call spreads, binary options, you can actually be your own market maker. So right now, I could buy this at 25, or I could buy this at 30. That's what, is basically, that's what the stock price on the shelf is. If I want to buy it, it's 30 bucks. I don't have to take that price though. What I can do, let's say I want to buy this at $28, right? No guarantee of a fill, but I'm going to place this order at 28. Now, if you look at the order ticket, right, somebody else was at 25. Now I'm at 28. So if I'm sitting at 28 and somebody wants to sell that contract, right, they have to fill me first. I'm what's called top of book. And so in this case, when the question is who's on the other side, and I think that people don't work orders enough. That's just my opinion. They just kind of take what's out there and they don't really try to work orders. If you look at like a lifetime of trading, if you can shave off 50 cents, a buck, $2 here on each contract, it could be a big difference. Now, there's no guarantee that I'm going to get filled here, right? There's no guarantee anybody else is going to take that 28. But if somebody wants to sell this contract right now, I'm giving them the best opportunity to do that, and we both benefit because I'm getting a better buy price and they're getting a better sell price, right? And so if we look at this, where you see the 30 and the 200, those are basically what are called market makers, which are quoting. They're obligated to do double-sided markets. Now, there are certain conditions. So, CB, to answer your question, it's not that that's where they're going to sell. They're basically looking at their whole book of business and they're trying to create a price, right? And provide that price that still gives them some type of margin to work with, just like a store owner. So on who's taking the other side, it could be a market maker, it could be, another individual trading the exchange. We've got another question here. What is the minimum you would suggest we deposit to open an account? You know what? I don't really have, I can tell you what the actual minimum is. The minimum is $250. The way I would actually phrase this, because everybody's different, everybody's going to trade differently. If you look at good risk management principles and you look at how you're going to be trading, right? So if you put in, and I'll just say, if you put in the minimum of $250, but you're planning to put $100 on your first trade and you're risking 40% of your account, that's probably not enough funding. So look at, and this is where it's helpful to spend a bit of time in demo. If you're trading one contract and you say, oh, wow, I'm typically buying at $40. Just throwing that number out. I'm typically buying at $40. That's $40 risk. If I have a $500 account, that's 8% of my account. Now that's certainly better than, 40%, right? But it might still be high for your risk things. So you might say, wow, I want to keep that really around 4%. I'm going to hold off trading live for a little bit. I'm going to save up till I get to 1,000. So that way I can actually trade. Now I've seen people put in $250. I've seen them put in 1,000. I've seen them put in 5,000. Seen them put in 500. I've seen people lose all of that they've put in, but I've also seen people at all different levels be successful because they were smart enough to start out slow. That's the biggest thing. The biggest thing, though, you have to know is it has to be risk capital. Absolutely has to be risk capital in this case. Right? No grocery money, no rent money. Let's see. So I'm going to answer, looks like I got a couple more questions here. I'm running a little bit over, so I'm going to take this. Stefan asked a question early on here about, so I showed how to take profits early. And the question is what makes a good buyer or seller? It actually goes more to what makes a good trader, and that's risk management, having a plan. I'm going to hop in, I'm going to hop into the Nadex website because to answer that question, Sivan, and also Jeff, your question about the RSI, I'm going to direct you to a video that I did a few weeks ago where we're like analyzing the current market, and I walked through a methodology that I've used for years to trade the market. It incorporates the RSI, and I'm just going to bring it up here real quick. You know what? Let me go to a different contract. I don't like these lines, so I'm just going to go back into a touch bracket contract. That's 500. We're just going to open this up, close this out, close this out. I'm going to go to the RSI, and we'll just walk through this real quick. You can adjust these settings if you want to. So if you click on the little flag there where it says RSI, if you want to change the period, the high-low levels, this is the standard configuration for most people. You can change colors. Pretty much all the indicators are. Oh yeah, Henry. Actually, while we're in the platform, I'll just walk through the gold and oil knockouts. So the knockouts on gold and oil though are exactly the same as how they're configured on that, but I'll walk through those as well. With the RSI, what I often look for is what's called trendline divergence. So historically, RSI, the way a lot of people use it, is overbought, oversold levels. Premise being, if it's at 70, it's over, if it goes below 30, it's oversold. That might be a time to buy. Now, the RSI is a standalone indicator. I don't like anything standalone, but I also don't like a ton of indicators on my platform. What I actually like the RSI for is when I'm trading patterns and I'm looking for a trend line divergence. And unfortunately, there's no alerts yet if it goes above 40. Alerts are another thing that's in development on the platform. Something I'd love to have as well. I'd actually love to have both audible, text, whatever alerts to do that. So what I mean by trend line divergence, and I'm not going to go deep into this because we're already running over, but I'm going to direct you to the video where you can. Thanks, thanks, Lawrence. Good to see you're on, and hopefully you're doing well. Wow, we go back a long ways, my friend, a long ways. Wow, 2009 probably, something like that. Wow. Okay. It's always great. You know, that's one of the reasons why I love doing these. You get people on that shockingly after this many years aren't tired of my banter and my voice. So real quick, RSI. If we see here, let's just zoom in here. This market kind of moved sideways, right? It dropped down, made a slightly newer low, right? In this case, though, we had the market kind of trending a little slightly down, more sideways. But we saw the RSI from this point actually going up, right? If I'd seen another pattern, that would actually be maybe someplace where I was looking to take a trade. I usually like to have 3 points. Again, as disclosure, I'm not allowed to trade Nadex contracts. I do trade a lot of other markets. I think Nadex are great contracts, but I have to remain unbiased. So here's maybe a little bit clearer example, right? We had a new high. We had the market moving up here. So made a high there, dropped back down, made a higher high. But when we made that higher high, the RSI had actually been slightly trending down. That may signal a shift. Again, you still need good risk management. Let me go into where you can find the 2 webinars that I'm referring to. So I'm just going to the Nadex website. And then, Henry, I promise I'll hop into the golden oil. So if you go to our Learning Center, underneath webinars, right? So hopefully you're all familiar with this page. This is the one we're doing right now. These are the upcoming ones, so if you want to register for those. But if you want to check out the ones we've done previously, the on-demand one, right? So, I mean, there's all sorts of education in here that you can just watch at your convenience. Let's see, I'm trying to remember. There's been a few. This one I love, the Be a Better Trader by Avoiding Pitfalls. That one I did a couple of weeks ago. This one here, if you want to watch it, Analyzing Current Markets Using the Nadex Platform, I want to say about the second half of that is where I go into how I use the RSI and really show it in combination with different patterns and different what I call harmonics and fractals. That's where you can find a lot more on how I use the RSI, Jeff. But you know what? Check out a lot of these. Brian Caprice does an excellent job on his webinars. But there's just a lot of information in here. So I know a lot of us have plenty of time these days. So you know, this is the opportunity to you know. I was actually speaking with somebody from the industry earlier today. She lives in Florida. Awesome lady, a real go-getter. But while this is tragic and terrible, we were both talking. It's almost like we have a responsibility, not just to sit around and not do anything for ourselves. This is rare in that it is an opportunity while we're healthy to increase our knowledge on trading, to actually get in there. More people have time now, unfortunately, and I have a lot of friends that have recently lost their jobs. I'm sure we all do, and we're all doing our best to help support them. But while we can, this is a good opportunity to really study those charts, to take on education, to attend webinars like this. That's why I'm so glad to see everybody on here. So let me hop back in here, and then I'm going to go into the gold and oil touch brackets real quick, and then I think I've Then I think I've hit all the questions. So let me go back into the markets here. That's 500. I'm going to go into the touch brackets right back here underneath commodities. Okay. So both gold and oil, and actually I guess I have to hurry because I know they're kind of closing quick. So here's crude oil. I'm just going to click on one of these. It's going to change to crude oil here. So I'm going to make a little bit of room on my chart. So again, configured just like, by the way, if you have indicators up and you want to just like say, hey, I want to look more at price action. Now here's something interesting, like oil. Wow, what a market that's been lately, right? We see where we put in that that low yesterday, and we're actually pushing back towards that right now. This is a pretty big low level, by the way, from a technical analysis perspective. But if I was thinking we're going to get a bounce here, so this is a $500 contract. So right now, I'm just going and I'm going to place this trade. So market's at 1957, floor at 1925. I'm going to click a buy. Now again, this is a weekly contract unless it's touched. But if I was to buy this contract, my risk is $37, not including exchange fees, maximum potential profit 465. Now again, if oil's really whipping around, this might be too close to the floor. I might not be giving enough room to really breathe in this respect. And so, but you know, if I decide to take this trade, I'm going to use my limit order here. By the way, if I wanted to say put down, I think 1950 is the level I want to buy. I think it's going to keep dropping a little bit. Maybe I thought it was going to keep dropping down to right about here to let's call it 1945. Right? I can go ahead and pre-place a buy order at 1945. Now, if it doesn't go down there and fill my order, right? Because I actually have to have my offer get down and hit that to fill it. Right now we're at 1963. But if it does, then I've lowered my risk, right? And then if it pops back up, or if it just starts to run now, well, then I miss that trade. Boo-hoo, happens quite a bit. So $500 contract on both crude and gold. Obviously, oil's been moving around like crazy. If we take a look at gold here, let's bring up these brackets. All right, gold whipping around as well. So this is one that we can see, this particular bracket that came up, kind of right in the middle of the range. Unless we're just really sitting there short-term scalping, there's really no benefit to that though, because they all move the same. So if you look at the pricing on all of these, now in some cases, somebody might be working an order, it'll be a little bit different, but they pretty much all update right about the same time. So even if you're scalping, there's no delay between the brackets. So you're better off mitigating risk. So let's say I wanted to sell this contract, right? I'm going to choose the one right here. So even if I'm selling it for a short-term scalp, I'm still going to, in case there's a weird, crazy move, I still want to have my lowest maximum risk. So this is also a $500 contract, and you can see that right there. It's kind of moving around a little bit. So we got our market order. By the way, one other thing I'll point out on the platform, you might notice there's a $3 variance, right? I say it's a $500 contract, but if you're paying attention, there's a bit of a variance there. That's because of the market with protection. It always has to account for the protection to give your maximum loss. So when you use a limit order, you can see this is a $500 contract. I can make $103, or I can lose $103, or I can make $397. And so that's the gold and oil. I'm very happy they've gotten a lot of attention. So I see I've run way over because I tend to talk a lot, as everybody I'm sure is aware. Again, check out our webinars. Let me go back. If you do have questions, one second here. If you have questions, give us a shout. So Henry, on the gold and oil, so there's going to be 4 different brackets. So in the case of oil, it's like the first floor is $1 away, the first ceiling is $1 away, and then $2, $2. Gold, which ticks in 50 points, will have a 10-point difference between the first floor, so $100 risk, and $100 between the first ceiling. The easiest thing though is because they're only at those levels typically for a minute after they open. So just go in and look at the brackets on the platform, and that'll be the best way to do it. But they're both $500 contracts. Gold is 50 total of 50 points. Oil is a total of $5. All right. Hopefully this video should be up no later than tomorrow morning, maybe later this evening. I've got to render it, get it off and upload it, and then it has to go through a review process. Make sure I didn't say anything really dumb, which I typically do it, in a lot of cases. But then, yeah, we'll try to get that posted. If not yet tonight, then tomorrow morning. With that, I want to thank everybody. Stay safe, stay healthy, stay indoors. Thanks again for joining us today. Hope you enjoyed it.